Sanjay Ladiwala. He's a cement expert now joining in. And, after having seen subdued demand, low utilization levels and weak prices, we understand that now the clinker utilization could improve to 91% by FY22. And that's going to, affect realizations, profitability for some of the cement players. Can you elaborate a little bit more? Do you think that the cement players have the discipline to play this theme effectively?
Well, eventually it's a matter of demand and supply. So profitability would imply better prices. Now, as of now, that is a cause for concern. We've seen attempts at increasing prices, which have been rolled back continuously. I'm sorry. These rollback of prices not helping any. And this crucial period, now we are seeing the peak period which is there, will actually decide whether the prices stabilize in this Jan to May period. If that happens, yes, it'll be a breather. But cause for concern mainly is the volumes. The rural sector, which is the individual housing sector, has by and large been quite steady over the last maybe a decade or so. But as of now, because of the problems with the agriculture segment, which is under stress now, that demand is not likely to pick up. And that is the real foundation on which all the demand is based. Infra also has been growing, but there have been some problems in the infra segment, political, financial, etc. So actually speaking, we are on a precipice, and this is the crucial juncture at which, unless the government does something to push infra and low-cost housing, volumes may not increase as much as anticipated or as much as it should be, which obviously would give the reason for either the price being supported or not. So basically this time the budget as well as the plans of the government in promoting infra will actually be the real reason for the growth or degrowth for the next year.
Modi as well joins in, analyst with Reliance Securities. Binod, we just heard out Mr. Ladiwala talking about how the volumes continue to remain a cause of concern, largely due to stress in the agri sector, the infrastructure space as well, that has been seeing some problems on the financial side. Do you also believe that now it's a case of just the government coming in, intervening, taking steps to revive both of these sectors, which are the basic core of improvement of demand within cement?
Yeah, certainly as far as demand is concerned, from the beginning of this financial year, it's not been, up to the mark. It's really been, declining consistently for last couple of quarters. And the prime reason for that, of course, there is, sharp slowdown in government spending as well as, significant. We have already seen number of projects got cancelled and delayed because of funding constraint. So here on, I believe, considering the fact the government seems, now that the infrastructure development is utmost important to drive the economy here on, and government has already announced as per NIP, over 100 lakh crore investment in next 5 years, and government is taking some concrete steps to make it true. So I believe even 70-80% of that investment, comes to in the system, right, through infrastructure development. We'll have, significant, kind of, cement consumption growth going forward. So yes, as of now, we can see that there should be some kind of, green shoots might be looking in coming months for cement space as a whole.
Sanjay, talk to us also about, the year gone by. Demand was elusive, capacity continued to increase. So, for 2020, what are going to be some of the major catalysts now for the sector? The government, of course, announcing that infrastructure push. That's a good start. What else do you see? How do you see players benefiting from that increased budget overlay?
Well, as of now, they're suffering because of volumes. That's the first. The volumes cannot be pushed by agriculture, mainly because that is dependent on the monsoons and nobody can do anything much about that. The demand should be coming from the infra segment. The question is how fast. And the faster it comes, the faster will be the growth. So, sorry. So we are seeing that the government push in the short term and at the highest level possible will actually be the driver for the next year. And I am quite optimistic on that front because the government is quite aware of the need to do this. So I think we should see a good 4 to 5% growth in demand year on year on FY21. And that also, this of course being a lower base, will be quite possible, and that also I'm being realistic. Optimistically speaking, people may be targeting that at about 6%, but I'm a little skeptical there.
Okay, fair enough. Binod, then let's get in your take about margin trends. What is it that you're expecting from the current levels, taking into account factors like input costs, the pet coke prices, which have been lower? What does that indicate on the margin front for some of the players?
Definitely, as far as margin are concerned, if I look at Q3 numbers for cement companies, as per our preview numbers that we have worked on, so it clearly appears that realization have been in pressure even in this quarter. Unlike the expectation, industry realization are likely to be down by about 2.5% to 3% sequentially. Right. So, so that thing, but still, I believe cement companies should report, decent sort of number, because when I say realizations are in pressure, but at the same time, there is cost deflation for cement companies in terms of lower fuel prices, as well as in this quarter, we'll have lower repairs and maintenance costs, right? Of course, there would be some kind of saving in the fixed cost because of, gradual improvement in utilization. So these all together will, negate the impact of realization decline for the quarter. So yes, I can see EBITDA pattern wise, whatever EBITDA pattern was company reported in the Q2, I think there should be more or less same. We will not see big mismatches from that EBITDA level. So I expect cement companies should report decent sort of number in this quarter as well, Q3.
Okay, Sanjay, let's get in a take on your outlook when it comes to the overall margin trends as well. Do you concur? What is the outlook based on the kind of input prices that we've seen? And as well, give us a sense as to how we've seen the overall margin trend shape up in the year gone by.
Well, in the year gone by, the margins have been under pressure, mainly because of the prices. The prices haven't been remunerative. If you compare the previous year and this year, there has been a marginal increase in the average price all throughout the year I'm talking about. And that does not augur too well and has therefore not been that good for the bottom line of the companies. Having said that, the good side is that cost pressures aren't so many. In fact, some costs have even come down, so margins should be relatively unaffected. But if the infrastructure segment, which is nearly 40% of the demand today, I'm including low-cost housing in that also because that is government finance driven, if that does pick up as has been envisaged or announced by the government, those volumes will really push up the prices. And if that happens, and also mainly because there isn't much capacity coming on stream, utilization levels will go up, prices will go up, and therefore the margins will be healthier. So it all depends on how fast the government acts on infrastructure. That is the crux of the whole matter.
As we wind down, just wanted to understand what are your top picks in the sector, because time and time again, the word is that stick with the leader of the pack, and that really is UltraTech Cement and maybe Indus Cement to some extent. But would you say that right now it's the bottom-up stories also which would be lucrative?
See, as far as calls are concerned, we stick with our calls in large cap. We like UltraTech and ACC. right? And the mid cap JK Cement continues to look good in terms of mid caps ideas, followed by Heidelberg, because in recent Heidelberg, like if I could give example of Heidelberg has corrected a bit in last 2-3 months, and valuations of the company appears to be quite attractive as of now, and company being into central region where we have seen demand and pricing really been consistent for last couple of months. So considering all these facts, JK Cement and Heidelberg looks to be good pick in mid-cap space.
Thank you, gentlemen, for joining us on the latest in the cement space, the sector, factors at play, what to watch out for. Thanks so much.